Alrighty, why don't we start the meeting? Welcome everybody to the completely hybrid meeting of the Pension and Benefits Board meeting. We will be without Leland and Rowena this morning, leaving the four members that make up the quorum: Paul, Tracy, Lorraine, Susan, and myself. So, first item on the agenda is the approval of the September meeting minutes. Is there a motion to approve those?
So moved.
By Susan. Seconded by anybody?
Second.
By Paul. All right. Yeah,
I had asked that they be corrected to reflect that I was at the last meeting. I'm just not sure whether that was done or not
okay.
yet.
Okay, we can note that correction.
Okay.
Make sure it's in there. Thanks. Any other comments? All right, hearing none, all those in favor signify by saying aye.
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 All right, I guess we're gonna go right to the action items, which is gonna get to them right here, which is the IPS modification. So, Leanne, do you want to discuss that with you and Kevin?
Yes.
Yeah.
Yes. So this is really, to be honest with you, just a Scribner's error. Apparently, the finance director cannot add to 100%. And we had the total asset allocation at 101%. So this policy just reduces it from 4 to 3%. And now it all adds up to 100%. This is just why we had to do this, is because these investment policy statements go out to our managers that manage our funds, and they needed something that's going to be accurate. And the most important thing of the policy is the asset allocation. So therefore, we had to correct this, and we would like to request a motion to approve this change so that we can get these policies out to our money managers to facilitate them.
I'll make the motion. Is there a second?
Second.
Any discussion, any questions for Leanne on this?
No.
No.
All right, hearing none, all those in favor signify by saying aye.
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 Aye. Those opposed? Thank you. Motion passes. All right, why don't we talk about the final review? So discussion and possible action on the final review of the town pension plan document. Go ahead, Leanne, why don't you jump in this?
Sure. So last pension board meeting, we had Becky Seelman, her last official business, unfortunately, with us. And she went over, we had hired Milliman to go over the addendum with us and guide us on this because, we wanted actuarial guidance on how to set the interest rates as well as actuarial guidance on the mortality tables. She gave her presentation. We received positive feedback from the pension board, and she has given us evergreen language, which is included in this document. Now, also she recommended that whatever we set our discount rate to is also the rate that we set for one of the other interest rate assumptions that are in that table. After the fact, so there was a few other things under there in that appendix that when we as a team had pulled out of the body of the plan document and put it into the appendix, thinking that we needed these interest rates to be set to market. As it turns out, I and I'm sure the rest of hopefully the committee too, has learned a lot about our pension document, that some of these things were in there, maybe as boilerplate. And so we did remove a few of those things that were originally in the appendix, and we just left them in the body of the document in case they ever come into play. Two of them had to relate with highly compensated individuals, those making over 280,000, which the town has none of. Mm-hmm. So, we thought it had something to do with people that retired before or after 62 or 65. That's not the case. Highly compensated, so we just took those out. And then there was another part in there that had benefits attributable to participant contributions. And we took that out because we do not allow that. That would have meant, the 5%, 6%, 7%, whatever the employee puts into the plan, that they could actually take that out in a lump sum, and then an annuity would be calculated with the balance as far as their pension retirement payment is concerned. So we don't do that. So we took that out of the calculation. And then I sent the final plan document to our actuaries as part of their exercise for reviewing everything. And there was just one section that they felt was better placed, and that had to do with when a retiree turns 62, they've already separated from employment, but we can't find them, and they show up a little bit later. How do we handle that gap between age 62 and whenever they come for their pension? So we moved that to a different part. Nothing has changed there, but pardon me, they also suggested that we put parameters around what does that mean if they show up late and we owe them money. So we said we will take, if it's $100,000 or less that we owe them, which will be, I'm sure, 99% of the cases, we will pay them in a lump sum. If it's greater than $100,000, we will have them actuarially change their pension contribution going forward. And so they were comfortable with that. And these, along with all of the other changes that you've already approved, should you approve them today, we will send this to the Board of Selectmen for final approval.
Leanne, you said pension, if they show up and if it's more than 100,000, you said it would change their pension contribution going forward. You meant pension payout.
I did. Their pension payroll, we
Yeah.
call it pension
Right.
payroll, their annuity.
All right. So for purposes of discussion, I'd like to make a motion to approve the final changes that Leanne just reviewed with us to the town pension plan document just to put it on the table.
Second.
Okay, seconded by Susan. Okay. Any comments, or anybody would like to, any particular questions?
So the effective date of all of this will be current? You don't have to go retrospective on anything?
No, we do not. And I think that we did discuss that with the actuary, and their recommendation is when it is approved, it is forward only for those folks that retire after this point.
So there's no impact on people currently receiving their pension?
Correct.
Mhm.
And, a lot of these changes that we have made, don't necessarily impact the majority of the pensioners anyway. Because a lot of them have to do with survivor benefits, which not everybody takes. And some of the other changes had to do specifically with the police department, and most folks that have made it to 23 years, 23 to 25 years are longer term anyway. So there's a lot of things in here that we are changing, but it does not have a large impact on the masses.
So are you required to notify participants or no?
No.
Okay.
No. We did ask that of both our lawyer and our actuary, by the way, too, because those questions were raised when we were doing the document review. How do we handle this? And so these document changes are effective, and this is the same with the fire department doc as well, plan doc. When we just changed the cost of living and all of those other formulary things, it is from that point going forward that it becomes effective.
Okay.
Thank you. Anything else, Paul or Lorraine, on this?
No,
No.
Okay, thank you. All right. Thank you, Leanne. Hearing no further discussion, and it's been moved and seconded. All those in favor of the changes signify by saying aye.
Aye.
All right, any opposed? All right, thank you. Thank you, Leanne, for diving deep and digging deep and all that. So, what we're gonna do now is move over to Janet. I know you're there.
As soon as I unmute myself, good morning, everyone.
Morning.
For our the pension payroll and retirement status report for October 1st, the pension gross payroll for the town, which includes the police and the Board of Ed, we had 100 retirees for a gross payroll of $174,498. We had 2 new retirees added to the payroll, the pension payroll. That was former Chief Spera and Wendy Mill. And then we had 1 retiree who passed away that I reported last month, Jean Kelly. So with our 1 QDRO spouse, we have a total of 101 participants. For the fire department, we have 40 retirees for a gross payroll of $17,482. There were no changes for the past 3 or 4 months. We still have 1 QDRO spouse for a total of 41 participants. For our pending retirements, former acting chief, Lieutenant Ryan Walsh, he retired on, his last day was October 3rd, retired with over 23 years of service. His pension calculation is pending with Milliman, and his pension commencement date will be November 1st, and hopefully we'll get the calculation back in time. Daniel Brigante, Board of Ed custodian, he will retire. I just received an update earlier this week. He's actually going to be retiring in February 1st, 2026. And he'll have just over 13 and a half years of service. For our, I'm sorry, I also wanted to report something else I just received news earlier this week. We did have 1 fire department retiree pass away, I believe over the weekend. Jacqueline Garrity, I checked our records. She retired in 2018 with 29 years of service, and then completed 1 more years of active duty in her retirement. So she had a total of 30 years of service to the fire department. And I'll get more information to you to report next month when I receive it. For our active employees that participate in our defined benefit and our defined contribution plans, as of the last payroll on October 10th, the DB plan has 27 contributing police officers, 20 contributing town employees, and 19 contributing Board of Ed employees, for a total of 66 participating employees. Our defined contribution retirement plan had 46 contributing town employees and 31 contributing Board of Ed employees, for a total of 77 employees. Total assets in the 401A plan were $2,697,117. The town 457B plan had 88 active employees. Total assets in the plan were $5,604,178. And 79% of our DB participants elect the additional employer match. It's 89% for the town and 65% for the Board of Ed.
Excuse me. Didn't hit the mute button fast enough. Thank you. Any questions for Janet on the pension payroll? Payroll. Yeah, I think we see the jump in the payroll. Actually, the jump in the payroll of about, since, I mean, it's about $15,000 higher than it was not too long ago, right, Janet? The way I'm looking at this,
Yes.
participants.
About 13, I would say.
Yeah.
Yeah.
Okay. And that's putting on some, significant retirees. So, all right. And that's it. And then we have your other report, your Excel spreadsheet reports.
Mhm.
So Any questions for Janice? So I have to get back to the agenda here. Any questions, comments?
Nope.
All right, thank you, Janet.
Welcome.
And hold on, oh, here we go. I'm back to the agenda. So nothing for the DB and DC tracking or gross payroll report that anyone has any questions on. Obviously, those are submitted every month. I guess we'll move on to Kevin and the pension perspectives.
Great, thank you so much. Can everyone see this?
Yep.
Okay. So first we're going to start with where we are, talk about, what's going on in the market right now. It's been a very interesting year in terms of the types of stocks that have done very, very well. And then kind of related, obviously, to the positioning of the DB portfolio. So first thing is, when we talk about what's happened since the October 22 lows, the market is up nearly 90% since then. People tend to forget that 2022 was a negative year, but the market's basically gone straight up since then, trading at almost 23 times forward earnings, which is near an all-time high in terms of valuation multiples. This has been the most extreme 6-month rebound since the lows of April. Outside of a recession, we're up nearly 40%, just since April, right? In history, it's the year to date. There's record outperformance right now of what's called the high beta factor. So this is just stocks that are extremely volatile versus stocks that are of quality, which is what the pension portfolio invests in. We've had extreme outperformance of small cap, micro cap stocks and stocks with no earnings basically very speculative kind of trading stocks. And so what we're seeing is that the volatility has gone straight to the upside. And we've seen very high levels of call buying. And a lot of this is driven by retail right now. And some of the slides that I will show you later on shows that cash on the sidelines is starting to kind of fade away. And I think what you saw yesterday in sort of the market action that we saw was quality did a teeny bit better yesterday. And a lot of the speculative stocks were down, 10-15%. The one that got the highest amount of traction, I would say, is Beyond Meat, which was up about 1,000% from its lows intraday, and then came down to where it was negative on the day. This is a trader's market, not really an investor's market right now. We think that in 2026 we're likely to show a little slower growth and sticky inflation, given sort of the I'd say more accommodative Fed that we have right now, which is deciding to tackle the unemployment problem rather than the inflation problem, because inflation is ticking up. And the expectation is that the Fed's going to cut at least 2 more times going into year end. Again, we think in 2026 growth is going to slow. PCE is going to increase to 3.9. CPI is going to peak close to 4%. Unemployment's going to go up close to 5%. So we have a lot of, I'd say negative headwinds going into next year. And while we do think that the 10-year yield is going to, decrease, it's at 3.99, basically 4% right now, to about 3.8%, we still think that there's going to be a big steepening of the yield curve. And that's what's happened. So even though we haven't really been super aggressive in increasing duration of the portfolio, when you look over the last 12 months, the shorter duration bonds have actually done better than the longer duration bonds. And we feel like that's going to continue to happen as we move forward in 2026. One of the things that's, again, concerning is that valuation multiples, while being at all-time highs, the consensus on the street is for $320 a share in 2026 earnings, which compares to about 240 in 2024. That's about a 35% increase in earnings year over year, for the 2 years. Again, close to record highs in terms of what we're seeing there. The GIC thinks that we could see our bull case of 7,200 by the end of the year, just given where kind of flows are mattering more than valuations. But our base case is 6,500. We think that pulls back, sometime next year, with growth maybe being, market growth being somewhere around 5 to 10%. So again, this chart right here will show you largest 6-month return of the S&P 500 outside of a recessionary environment. That's where we are today. One of the things that has been different with this market this year is not only the high beta stocks doing well, but international stocks finally catching up. We've talked about this. The diversification of the portfolio is important, and international and emerging markets have been big contributors to the portfolio this year. We go to page 10. This will kind of give you a sense of where we are. So quality factor has been terrible all year, historically. And you can see here that realized volatility is a year-to-date returns, and high beta have returned 62% and 36% respectively. When we look at quality and value and dividend yield, those are lagging by 20% basically to these high beta stocks. So momentum and beta has mattered more than any sort of valuation or quality factor. And in fact, it's been one of the tougher years for active management, as just 8% of small cap managers have beaten their index this year. 8%. And the types of stocks that are going up, and I have this one example. There's a stock, Cipher Mining. I think I told you about it maybe last month. CIFR. They signed a lease agreement with a Google-owned company for 10 years to mine Bitcoin. The stock went from almost being bankrupt to $20 a share on basically a lease agreement that was a few $100 million. The stock gained about $5 billion in market cap. Okay, it has no earnings. This is just pure speculation. There's a lot of leverage in the system. I think you saw the volatility in a lot of the Bitcoin and things like that last week. And these are things that we consider to be risks as we go forward. Another risk that we have here is markets are expensive. We've talked about this. They're ad nauseum. We're looking at low realized equity risk premiums, and everything basically trading at all-time highs or close to all-time highs in terms of valuation multiples. One of the things that has obviously driven this has been obviously the AI trade. We've talked about that as well. Here's the AI ecosystem. When we talked about the Bloomberg chart that they had put out in terms of the interconnectivity of all these different companies, data centers, private companies within AI. And while this is not something that would be concerning in any sort of industry, one of the big things that's happening is they're lending money to each other to buy each other's products. For example, NVIDIA gave OpenAI $100 million just about a month or two ago so that they could buy their own chips. So they're not going to the private markets or to the banks to get financing. They're just getting financing from each other. So if there's going to be a credit event where they don't pay back a loan, let's just say, like NVIDIA doesn't pay back a loan to CoreWeave or something like that, the interconnectivity here is going to cause a big credit event within these companies. Now, when I look at this doesn't remind me of the internet bubble of 1999. This reminds me more of the financial crisis of 2008. If you just replaced all these AI companies with JP Morgan, Morgan Stanley, Goldman Sachs, Merrill Lynch, it looked like the collateralized mortgage obligation crisis. So again, a risk that we are monitoring. There's been some cracks in private credit, which is related to this that we've seen, and sort of monitoring the situation in terms of the risk within AI and how much of a contributor it's been to GDP growth over the last few years. Then finally, I talked about this. The cash on the sidelines looks exhausted in terms of client cash as a share of total assets has really come down to all-time lows of the last 25 years. And relative to the S&P 500 market cap is also down near all-time lows. So we think that sort of tailwind for the market is probably in the ninth inning right now. Any questions before I move on?
Yeah, I do. Good morning, Kevin.
Morning, Paul.
I happened to see Mike Wilson, and for everybody's benefit, Mike is the investment strategist for Morgan Stanley. And he was, for Mike Wilson, he was much more upbeat than I remember in the last year or two. I think he said that we were just coming out of a rolling recession, and that he's become quite positive relative to where he's been in the past. And I was very surprised by it. I think that it's something that we should certainly discuss. And I'm just wondering what your thoughts are. Did I get that right? Did I hear him correctly? I think, as I recall, he said we could have a 10% correction before the end of the year. That wouldn't surprise him. But on balance, he expected to see a very good next year. So
Mike Wilson is part of the Global Investment Committee that actually puts these slides together.
Right.
And so I think we're not calling for, a recessionary environment. We're just calling for slower growth next year. And I think what Mike is really talking about here is, the market minus the Mag 7 really participating and finally starting to participate,
Right.
and having more market breadth, right? So when you look at sort of, what we think is going to happen is you can kind of see here as we kind of move forward that Magnificent Seven net income is decreasing basically as we go into next year, but the 493 is starting to increase, right? And so our thought is that the earnings expectations for the 493 are extremely low, and they'll probably be beat as we go into next year. The issue is going to be, for the Magnificent Seven, how fast is this, going to decline, and what is the market going to care that this, these earnings expectations are declining and net income expectations are declining, given the valuations that you're paying for it. If we go to page, here we go. This is, current consensus. Again, we're around 6,600, 6,500 is what, our basically Global Investment Office is saying. Mike Wilson has a much wider sort of net, as you can see here, because it depends on where multiples and earnings per share go, right? So if we get like $300 of earnings per share and have, a multiple of 21, we could see a correction down to 6,300. If we continue at the multiples that we're at, we're going to 6,900, right? If the market trades at higher multiples, we're going to 7,200, et cetera. So, he sees a much wider net in terms of where we think we could be going into the next 12 months. And it really depends, again, on where earnings per share ends up. But I think that Morgan Stanley has always been a little bit more bearish in terms of the earnings per share estimates. Like I said, like consensus is around 320. I'd say we're somewhere like just over 300. But it depends on the multiples that investors continue to want to pay for these stocks, which have been at, all-time highs, as I said. So I think it's just a little more constructive on breadth of the market as opposed to, the concentration that we've seen over the last 2-3 years.
So you don't think there's anything that we should do or or you're not, is there anything you're considering doing, I should say,
Well,
to
you know,
to
here's the
tweak
thing
the
is we've been
portfolio in that
diversified.
direction?
Yeah, no, that's a great question. We've been diversified, right? In terms of like our allocations to, you know, international and US, small cap, mid cap, large cap. That has been fine. We've strayed towards quality. We've always been towards quality rather than beta, right? So what we're going to do right now is we're going to stay the course because we don't want to be chasing returns in a high beta market, which is trading at all-time highs. And one of the managers that you have, London Company, sent this over just to kind of give you a sense of what they're seeing and how we think forward returns could look as we move forward for the quality that we have in the portfolio. First of all, it's the fourth highest beta rally in history, okay, in terms of the Russell 1000, top 1000 stocks. All right. Other times were during COVID, obviously, you know, leading up to the financial crisis, and then in the tech bubble. When we look at what has happened for the 3 and 5 year periods moving forward off of these beta rallies, you can see that low beta or higher quality, lower volatility stocks have done better than the high volatility stocks following these types of rallies. So the 3-year average is somewhere around 8%. Okay, that's per year. And then the 5 year is somewhere around 5% excess return. All right, in terms of quality over low quality, low beta over high beta. So we're low beta, we're high quality. We'd expect these things to revert at some point, and we don't want to be changing the portfolio's, you know, bias towards quality, given where we are, you know, and given where the beta rally has been this year. Another one is this is Siegel Bryant Hamel. So this is the Russell 2500, which has even seen more higher beta than the Russell 1000. And you can see that the most volatile top 2 deciles, right, for the quarter, we're up almost 40 and 25%. And for the year are up over 45 and 47%, right? So, and least volatile, I mean, the dispersion is, you know, 4,000 basis points. It's unbelievable. So again, these high volatile, low quality, high volatility stocks have outperformed, but the managers are saying, you know, as we look at, again, 5 years and 10 years going forward, quality will do better in these indices.
Yeah, the only other question I had from that our material is the performance of the mid cap. Again, I know we've talked about it several times.
So that goes back.
I know they're relatively new, but you know, does it make sense just to go to an index fund for mid cap?
So this is sort of part of this right here, right? This is the same kind of things happening in the mid cap index, where again, high beta, low quality has done very, very well. So we've moved, you know, half of it over to the index. I'm not ready to go 100% into the index right now, given this beta sort of, you know, factor that we're concerned about. I'd rather wait to see if there's a, you know, again, a correction. And Ken Anderson over, you know, longer periods of time has done very, very well. You know, you look at Siegel Bryant, you look at them, you know, they've had significant underperformance this year due to this, you know, this beta factor that has been creeping in the markets. But when we look at what's happened this month, the good news is that Siegel Bryant is doing much better, outperforming by about 70 basis points, and that Ken Anderson's outperforming by about 25 basis points. So it's starting to change a teeny bit. So we did make the change to go to half index in mid cap, but I don't want to go 100% index given this information that we have here.
Okay, thanks.
Kevin, you talked about less money on the retail side, less cash on the sidelines. And that's kind of maybe not the retail, but you've heard about corporations having a lot of cash
Yep.
on the sideline. So, what's going to drive the market forward? Where's the investment going to come from?
So, one, you have, again, retail is buying, whether it's in their 401ks or 457s, like every month they're putting money into the market, right? And a lot of people, I think we've talked about this too. A lot of people over the last few years have said, put me in the riskiest thing that you can find. Just put me in the riskiest thing. I want the highest return. It's kind of like risk be damned, that works in shorter periods of times. Over longer periods of times, you get a little disappointed because you get enamored by the 20% returns, and then when you lose 20%, or 30%, it's like, how could this happen, right? So I think being more balanced is important. I think, again, earnings expectations are going to drive the market going forward, right? Because if you're paying up at a very high price for a stock and it does not deliver its earnings expectations, then that stock is going to, not be rewarded by the market. Conversely, if it beats, then it will be rewarded by the market. So you've seen a lot of volatility, again, in these names that haven't met their earnings expectations and have been down because they didn't make some sort of, whisper number on the street, right? M&A could be something, to your point about, record corporate cash. M&A could be something that, next year is important as corporations decide to deploy that cash. But again, just kind of put some things in context, all right, in terms of AI's ability to do acquisitions and continue the pace that they're on, right? So both Apple and Meta have pledged to Washington that they're going to spend $600 billion over the next 5 years on AI and AI infrastructure. Okay, $600 billion. That's $120 billion a year. Okay, their current capital expenditures are a tenth of that, 1/10. So they have to increase their capital expenditures by tenfold somehow every single year for the next 5 years. And where is that money going to come from? Well, it could come from corporate cash, which they don't have that much on hand right now. It could come from corporate cash. It could come from synergies by, buying other companies and then right-sizing those companies. But we really feel like it's a very aggressive, position for the market to be in, expecting the amount of, the amount of development, the amount of money that's going to be thrown at this. I think if you go back to, one of the slides, I said, we think the AI infrastructure build is closer to the 7th inning, not the 2nd inning. And you're seeing a lot of companies starting to pull back on, building more data centers. Microsoft is one of them who's, and then you're also seeing, don't forget, a lot of public backlash from these data centers being built in, different locations because of the utilities and the electricity required, right? I think in Wisconsin, there was one that they voted down. And I know that there was another one somewhere, I can't remember off the top of my head, that was voted down. So it's like, people want this, but not in my backyard if it's going to, increase my, electric bill. So there's a lot of, I'd say, negative publicity around data centers right now too.
Hey, Kev, an interesting point I heard yesterday, there was a deal that was just struck with Blue Owl, and I don't recall who else,
Yep.
for a data center in, I think, Louisiana. And the size of it would be equivalent to 1,700 football fields.
Jeez.
1,700. So it would be roughly, I think it was roughly the size of Central Park.
Yeah,
Um,
it's insane.
I mean, it's just breathtaking what's what's underway.
Yeah, and we just don't have the energy power to power these things, for the expectation that we have. Now, there's a lot of thought that nuclear is going to come online and they're going to, build a lot more nuclear plants or bring them back online or whatever it may be to help fuel this. But it takes a long time to build those out, one. And two, it takes a long time to bring, even if they are built out, to bring them back up to speed. I know that 3 Mile Island was something that, they were talking about, turning back, basically coming back to full capacity. That's going to take 3 to 5 years at least, and not just something that's local. I mean, forget it. That's something that's already built too. But yeah, the size and the scale of these things are enormous, and the amount of power that's required to, keep them going is enormous as well.
Carl, I don't think we want a data center in Old Saybrook. It would cover our footprint.
So Kevin, I mean, this is a little bit of a tangent. I listened to a podcast about data centers, and there was some guy from Goldman, or who was the interviewee. It was on Plain English by Derek Thompson. It's a good I think it's a great podcast, actually. Random topics. They were just talking about, you build a data center and you put all this stuff in it. Now, data centers are built presumably for 20 years. It's a warehouse, whereas the technology has a 2 to 3 year life cycle.
Correct.
And how there's this froth to get these built and to get all this equipment in there, and these leases for 20 years, whereas the substance of the lease is valid, has a 2 to 4 year life expectancy. So he was very concerned about a year from now, a year to 3, seeing some sort of real correction in this whole industry. I'm not phrasing that perfectly, but
yeah, no. So I think what you're saying is, like, I think the market is looking at that as like a fixed cost as opposed to a variable cost. Simple as that, right? They're looking at it as like a fixed lease cost with no, not having to upgrade the infrastructure inside the
right.
inside the data center, and it's a variable cost, to your point. And then don't forget about the electricity. You have to cool these things too. I mean, if you have a bunch of servers running, right, they throw off heat, so there needs to be cooling inside the data center as well, which requires even more electricity. So it's something, I think, going back to that interconnected sort of slide that we had, which I think was on 15. I want to say, where'd it go? Oh no, it's 34. Sorry. Right here. I mean, just going back to this, it's just, there's a lot of interconnectedness between everyone. And if there's a crack in the system, we feel like it's gonna affect every single one of these players. And it could be at a data center level, it could be at a company level, could be a credit level, could be a private equity firm like Blue Owl, because they're all in the same deals. All these private credit funds are all in the same types of deals, and a lot of them have to do with data centers. It's kind of the hot place to be right now, and it's been a great investment for the last I'd say 5 years. It certainly has been a great investment. But the problem is now is that you're paying again higher and higher costs, higher and higher costs to build these data centers, and they want longer leases, which again have variable costs associated with them. So it is something that we're paying attention to. It's something that is a risk to the market, because again, half of the GDP growth that we have right now is literally due to AI infrastructure spending. The other half is consumer spending. So we've gone from being a consumer economy to a consumer and AI driven economy.
All right. Thank you. What else?
So I'm just going to hand it over to Becky to go through the performance quickly.
Good morning, everyone. And then the other part of the, Carl, if we have time, is to just touch on the Q3 of the defined contribution plans. But yeah, looking at the performance report, you know, we can see here that quarter to date, we have just over 3% return. Kevin gave great commentary on the rationale for why we are, you know, have a number that's slightly below the benchmark. For the past 5 years, we're at over 8%. On the bottom right-hand corner, we can see the income of just over 720,000 projected for the next 12 months. As we say, you know, every meeting, a core component of our portfolio construction and how we look at, you know, tending to the liabilities for the pension. We can go down to the next page, Kevin. Here you can see the portfolio is the blue circle, and we are right in line in terms of standard deviation with the benchmark. And then if we go to the next page, actually we'll skip down to page 8 on the performance over time. Yeah, so, you know, Kevin talked a little bit about why we are, you know, slightly underperforming, but year to date, really in terms of, you know, relative to other years, you know, pretty good performance of just over 10% year to date. Last 12 months, over 8%. Last 3 years were at, you know, I'm having a hard time, like just over 13%. So feeling very good about the return for the year. And again, Kevin gave a lot of context for that and previously. So we can skip down to page 10. Yep,
I
question?
just want to point out too, in terms of where you are at the end, you know, at the end of yesterday, you're up about 40 basis points for the month, and year to date, it's about 10.5% fiscal year to date, 425. So, you know, for the fiscal year, you know, basically, you know, 4-ish months, you know, we're kind of right on track for where we were last year in terms of return. Sorry, back to you, Becky.
Yeah, thank you. So, you know, again, you know, well-diversified portfolio has really helped us over time. You can see here that just in terms of the targets, we're very close on in every asset class to, you know, to basically the target. We are a little bit shorter still on the fixed income. I'll touch on that when we get down to the fixed income page. Next page. And then we can see, you know, again, you know, the asset class that we talk about a lot, sometimes in not favorable ways, emerging markets, and a good contributor this year, certainly in the past quarter. And we can move down to page 13 on the manager performance. And if we kind of stick to that middle column, the year to date, you know, everything kind of holding in line. Paul, you mentioned it earlier, a little bit of difficulty in the mid cap and the small cap space. It's kind of interesting to see actually the performance of the ETF year to date is less than the manager. You know, kind of an interesting situation in that regard. And then for the international and emerging markets, you know, both over 20%. Those are the highest performing areas of the portfolio year to date.
I just want to kind of interject here in terms of the mid cap ETF. You know, these numbers, obviously, we just started this, you know, last month. So the benchmark number and the you know, the return number really isn't fully reflective of obviously for the year. It's really just the, you know, the month that we've seen here. So.
And we can go down to page 18. Our fixed income holdings, you can see the bar chart in the middle of the page is we're kind of increasing out on the duration. You can see more on the 4-year, 5-year, 6-year than we've had in the past. High quality just the same that we've always had. And then next page, Kevin. Overall, our modified duration is still, just about 6.5. So with our yield to maturity of 4.6. So a really great, ratio in that regard. Kevin talked about the potential steepening of the yield curve, which is a reason, that the short-term maturities will continue to do well. It's been quite a few years now that where we've seen very positive moves in the bond market, but so many years that you would see that current yield or the kind of middle column about the unrealized gain loss, the previous column to that, Kevin. And that would be, negative. As soon as you buy a bond, it would start decreasing in value. That wouldn't mean much to us because we hold it to maturity. But you can see here quite significant gains in the unrealized gains in the bond holdings.
And I just want to take it back to the performance here for the bonds. So while there's been a lot of talk about the move in the 10-year and how much has come down, again, the steepening is continuing to happen. So the short-term bonds have gone down in yield more than long-term bonds. And we look at, our short-term bond ladder last 12 months, outperforming the long-term, or the intermediate term, I should say, manager by about 100 basis points, lagging year to date by 70 basis points, but you can, basically in line quarter to date and a little bit higher month to date as the yield curve keeps steepening. So even though we've, stayed more short duration, it hasn't, hurt the portfolio over the longer periods of time.
And then I was going to wrap up on page 31, which is just the income projections. And so just, again, looking at that really nice even distribution of income coming in month to month, quarter to quarter for the next 12 months for the portfolio.
Any questions on the performance report? I mean, I'd say the good news is that, the fund's at an all-time high, just like it was last, I think as of yesterday, it's actually over $30.7 million. The bad news has been it's really difficult for, active managers due to this beta rally. So we're going to continue to monitor that and see if we need to, make any changes. But for now, we're going to stay the course. And we really feel that quality over the next, few cycles will come back into the fray.
All right. Questions? Sure, there's some. Paul, come on. No, I know. I mean, you look at those. I mean, overall return's been good, but I mean, you look at the underperformance, but you've tried to explain that a little bit. Anything for Kevin from anybody? Okay, hearing none. Thank you
Thank you.
for a little easier trip for you today.
Love coming up there.
Yeah.
No worries.
All right. Leanne?
Yes, I just have one thing I wanted to give an update on. This is the Employee Benefit Committee as well as Pension Committee. And we received notice from Connecticut, which provides our Advantage plans for our retirees, that they were no longer going to offer the Advantage plan to us. So our retirees did receive a notice that that the plan wasn't going to be offered, and we had to reassess what we were going to do. We have about 30 low 30s of retirees on these plans. And so we are going to be swapping from a Medicare Advantage plan, which is really a one-stop shop. Everything is in there, health, vision, prescriptions, to a Medicare supplemental plan and a prescription plan. So they're going to have a couple more cards than they used to, but we have notified them. And so I just wanted to make everyone aware. You may have been reading about Medicare Advantage plans, and their Disappearing Act. And we have been also affected by that. But our retirees are fine. Their coverage is going to be very simple. In fact, one of the benefits of the Medicare supplemental plan is that you can use them anywhere in the United States. So we think that they're going to continue to be well covered going forward. And the cost, I think, remained, it's a little bit higher, but it wasn't terribly unreasonable.
Why
So a
didn't you want to find another Medicare Advantage plan?
Because we only had, well, it's not that we didn't want to, our broker, Brown and Brown, couldn't find one. We have a very small group. And as they explained, it's very hard to find coverage for a group of just 30 participants.
So a couple things. It's a small group. It's not a growing group, for the most part. So this is never going to be a group that is going to go from 30 to 40 to 50 to 60. So this cost is going to be relatively stable and declining long term. That's number one. Number two, we found ourselves in a situation where so Medicare Disadvantage, Medicare Disadvantage was
Freudian.
Connecticut was discontinuing. So, our first thought in some ways was to say, okay, we're in a pinch. We'll just send money to our pensioners and say, here's $500 a month. Spend it like you want. Some of them, there are zero cost plans where you pay,
Right.
you go to a doctor and you pay $20 instead of having it be covered. And you go, if you need certain types of care, you may have a larger deductible, you have to pay it, but it's more catastrophic. So there are those plans out there. However, the language we ran this by our attorney and said, can we do this? Can we just cut the cord on this, make it a stipend and be done with it? And it's a fixed stipend forever, declining cost for the town. And the language says that the town shall, mandatory language, offer a supplemental plan. And supplemental plan doesn't mean a Medicare supplement. It was just, we're gonna supplemental in the more, as you would use it at the dinner table, supplemental. So our attorney said, while these folks are no longer in the union and they can't grieve, if you said, hey, here's $500, they can't turn around and file a grievance. They have a contract with the town with that language. And therefore, you can't just offer money. You must offer a plan of some sort. So that was the legal determination, because our first inclination was, let's make this simple. Let's just cut a check. Which, by the way, maybe of the 30 or 35, however many there are, maybe 30 would have been good with it, but 3 wouldn't have. And now we find ourselves in a situation where we violated a contract. So we went out. The good news is this is not a huge cost to the town in any event. It's $500 a month, so it's call it six or a little bit more than that. So it's $600 per retiree per year. Do I have that? No. What am I talking?
Yeah, it's a little under 600, yeah, per
so
month.
it's not small. It's not a tiny cost, but it shouldn't be an ever-growing cost. The supplement plan will increase over time. The pool should decrease.
Okay, thank you.
So nothing's easy, and everything takes a little bit more digging, even these little minor issues sometimes. Any questions? All right, any other comments for the good of the committee from the members who are present today?
Becky, did you have another document you wanted us to quickly look at?
What document?
I thought Becky said she wanted to
something on defined contribution?
Sure. If there's time for it, happily quickly go over that,
Sure.
or we can table it for next
Well,
meeting.
why don't we start? What is it?
It is the defined contributions to the 401A and 457. Janet already covered some of it. Just kind of highlighting this is as of Q3 2025. So it is really nice to see, just kind of that the combined valuations of both the 457 and the 401A are over $8 million. You can, actually on the next page here, I've shown the growth. Again, this is a recap of Janet's numbers, and it's actually a very good exercise that Janet and I have been going through on a quarterly basis to see, to kind of reconcile the Empower numbers that I get from Empower and her payroll numbers. Her payroll numbers are always the correct ones. So, but we can just see that, when we started, this is back in September 2021. So a couple of years ago, we were at 3.7 million, and now we're at 8.2 million. So just kind of nice growth in the plans. We thought that would be a nice thing to share. And then the analytics behind it, let me see if I can get to that. The other document, kind of buried behind lots of other things here. And get to it. Here it is, the report, the kind of the behind the scene reports that we do for all the investments within the defined contribution plans. And so just to show you, what the breakdown is, again, very healthy, almost 40% of participants are choosing to be in the target date funds. We can see that that's pretty stable from quarter to quarter. And then the other, this is a very lengthy document, over 100 pages of analytics on all the, here are all the funds that are, and all the dollar values that are within investment options to the participants. And then most importantly, the analytics that we do on rating those investment funds. And if they are, match the quality of criteria that we're looking for, or if they're below criteria. And we have made a couple changes in the past. You can see these yellow dots are where we have concerns. These are old quarters. There's one or two blips from the last quarter, but to look for, or to really suggest switching on a fund, that would be over multiple market quarters that we see either degradation in performance or lack of meeting the criteria. So again, lots of analytics, happy to share this or have it on file with the town, but know that this is all going on behind the scenes. And that's it, unless there's any other questions.
Just one.
Oh, go ahead. Go ahead, say your question.
Yeah.
Okay. On the first sheet, there's a indication of fees. Are those the Morgan Stanley fees, or are those fees for something else? Just was not sure about that.
Those are the fees for the plans themselves. So part of that goes to Empower, part of that goes to Morgan Stanley.
Okay. Thank you.
And just a quick note, the forfeiture fund right now we're at for the 401A is 57,000. So the fees are coming out of that forfeiture fund. So that's just also a nice thing to note.
Yeah, they're not coming out of the participant accounts or anything like that, because there's so much money in the forfeiture account. So we're going to use that until, obviously that gets dwindled down, but plenty of money in there. Two things I wanted to kind of point out on, Becky's kind of commentary here is, one is, when we started working with the DC plan in 2021, the assets between the two were just under 3.5 million. So the growth that we've seen to almost 8 million now, you know, over the last basically 4+ years, is pretty impressive in terms of, you know, the contributions that the town has made and the participation of all the employees. And then the second thing, which is actually on fees, is that once it crosses $10 million, we will reduce the fee from 25 basis points down to 20 basis points in terms of Morgan Stanley's fee. So you'll get a you know, a reduction in fee there. So we're on our way, basically, is what's happening.
You're on mute, Carl.
Thank you. All right, very good. Leanne, anybody else, anything? Any questions? Thank you all for being here.
Motion to adjourn.
Second, all those in favor?
Aye.
Enjoy the day. Beautiful weather coming up the next few
Yes,
days.
thanks all.
We'll see ya.
Thank you, everyone. Have a good one. Take care.